Welcome! Today we'll cover the three main approaches used in real estate appraisal: the sales comparison approach, cost approach, and income approach. Let's break down each one with examples. Let's start with the sales comparison approach. This method compares the subject property to similar properties that have recently sold in the area. We make adjustments for differences between properties to determine market value. Next is the cost approach. This method estimates value by calculating the cost to build a new property minus depreciation plus land value. Let's break down the types of depreciation. Let's look at physical deterioration with an example. If a roof has an expected life of 20 years and is 5 years old, it has lost 25% of its value. For a $50,000 roof, that's $12,500 in physical depreciation. Finally, let's examine the income approach. One common method is the gross rent multiplier, or GRM. This is calculated by dividing the sales price by the annual gross rent. Let's work through an example. A property sells for $300,000 and rents for $2,000 per month. The annual rent is $24,000, so the GRM would be 12.5. To use the GRM to estimate value, multiply the annual rent by the GRM. For example, if a property rents for $30,000 annually and similar properties have a GRM of 12, the estimated value would be $360,000. Remember, each approach has its strengths and is most appropriate for different property types. The sales comparison approach works well for residential properties, the cost approach for new or special use properties, and the income approach for investment properties.